Hey everyone, so my name is Zach Vines, and what we're going to look at today are just the various methods that we use to calculate our allowance for doubtful accounts. So just in general, to touch back on the purpose of allowance for doubtful accounts, what's going on is that we as a company like to make sales on account, meaning that we don't necessarily charge cash to a customer for a sale. We can essentially put it on their tab. Let's go ahead and recognize the transaction now. I'll recognize my revenue, you recognize your expense, and we square away the cash later. But we all know that it's not going to be the case that every company pays all of their payables in cash in full on time every single time. So what we do is we create a provision or an offsetting contra account called the allowance for doubtful accounts that essentially represents the future amount that we think is going to be uncollectible from our accounts receivable. We have another video that goes over the entire purpose of it and a lot of the nuance involved with the journal entries and everything. I'll put the link in the description for that, but what we're going to look at today are the various methods we use to actually calculate that number. There's a few different ones. You're probably just introduced to maybe one or two to begin with, so you didn't know there are different methods, but let's go ahead and talk about that. So the way you estimate your allowance for doubtful accounts and the associated bad debt expense, you might know that as uncollectible accounts expense, when you create that estimate in the first place is different depending on the exact method you use. So the three methods we're going to talk about are your percent of receivables method, your percent of sales or percent of credit sales method, and then an aging method. And we're going to do one example. It's going to be the same numbers, but you're going to see that based on the method we use, it's going to give you different values. But to sum it up, your percent of receivables method is known as your balance sheet method because what we're using is your accounts receivable. It's a percent of your receivables that's going to give you your desired ending allowance for doubtful accounts. So you're going to start with some amount. You have to make an adjustment to equal that ending balance right there. So it's the balance sheet method because it uses the accounts receivable balance sheet item. Whereas the percent of credit sales method is known as the income statement method because it uses the sales or the revenue item from the income statement as opposed to the receivables from the balance sheet. And thus what we get when we do that, the percent of the sales, is the adjustment to the allowance for doubtful accounts. Not the desired ending allowance for doubtful accounts, but really what you recognize as an additional allowance for doubtful accounts, which is basically your bad debt expense or your uncollectible accounts expense, depending on what you call it. We'll get into the details of that, just an example in just a second. And then finally, the aging method is just a totally different method where we have various categories based on how long it's been since that credit sale took place and we haven't collected it for a certain period of time. We say that it's a certain percent uncollectible. We pretty much come with a weighted average of all of that, and that again is going to give us our desired ending ADA. So I think these are best illustrated with an example, so let's get into the percent of receivables method to start off with. All right, so the example we have right here is that we start off with $100,000 in our accounts receivable at the beginning of the year. We make credit sales of $30,000 and we collect cash from our accounts receivable of $13,000. We began the year with $500 already sitting in our allowance for doubtful accounts, so clearly we've been operating for a couple of years now, and we estimate that 3% of our receivables are uncollectible. So you can see that the example we're looking at here is a percent of receivables method, and remember, the way that works is that when you take a percent of your receivables, that gives you your ending balance in your allowance for doubtful accounts. And so that's going to affect the way you solve the ending ADA versus the bad debt expense. So keep that in mind as we're going forward. So that's exactly what we're going to find is the ending allowance for doubtful accounts and your bad debt expense, your BDE. I've just abbreviated it. So to find the ending ADA, it's as simple as taking 3% of your 117, which is your accounts receivable balance. The way I got that accounts receivable balance was just by compiling the information from the problem. So I started off with $100,000 in my accounts receivable. I made credit sales of $30,000, meaning all those were on account, so it increases my accounts receivable. I collect $13,000 from my accounts receivable, so it reduces the balance in that account, leaving me with $117,000. So as of year end, I have $117,000 sitting in my accounts receivable. So if I'm saying that 3% of it is going to be uncollectible, take 3% of that $117,000, and that is the ending balance in your allowance for doubtful accounts for the end of the year. So when they're asking about the bad debt expense, remember that the bad debt expense only happens whenever we're pretty much reassessing our estimate for the allowance for doubtful accounts, meaning that there's a couple of things that affect your allowance for doubtful accounts. Like in the previous video, we talked about write-offs of allowance for doubtful accounts, reversing write-offs, and creating the allowance for doubtful accounts in the first place, all impact the allowance for doubtful accounts. But the bad debt expense, the only thing that impacts that is when we create the estimate. Write-offs don't impact it, nothing like that. So if we're beginning the year with 500 in our ADA, we start with that much. We're ending the year with 3510 in our ADA. That must mean, considering there's no write-offs or anything like that, the adjustment to that account is going to be the bad debt expense. So you just plug what is the difference between the 500 and the 3510. So how do you get from there to there? It's just going to be an extra 3,010. And that's going to be your bad debt expense. So that's how you do the percent of receivables method. So let's move on to the percent of credit sales method. Okay, so now what we're dealing with is a percent of credit sales method. So everything is exactly the same, except you can see that I changed that instead of talking about a certain percent of our receivables, we're saying that 5% of our credit sales are uncollectible. So remember from the first set of information I gave you for this video, the percent of credit sales method actually gives you the adjustment to your allowance for doubtful accounts. So the bad debt expense is what you directly find when you do this method. So all I'm doing is taking 5% of my credit sales. What are my credit sales? 30,000. It just says it right in the very beginning of the problem. So I'm going to take, so you should solve for the bad debt expense first. You have your 30,000 of credit sales, take 5% of that, you do that, and that's going to be $1,500. And that is your adjustment to your allowance for doubtful accounts to give you your ending allowance for doubtful accounts. So you see here, if we began with 500 from the information in the problem, we include or adjust it by the 1,500 that we calculated. That gives you an ending allowance for doubtful accounts of 2,000. So I feel like that's pretty straightforward. Let's get into one last example dealing with the aging method. You're going to see it's a little bit different. Just the entire organization of the information they give you in the problem is different. It might not be exactly the same as what we have right here, but you'll see how it works. It should apply to a lot of different aging method problems, so let's look at that right now. Okay, so now what we're dealing with is the aging method, and again, already you can tell that the entire organization of it is different, but here's what's going on with it. So we have various sales that we made on account, and we're talking about the time frame of how much time has gone by since that sale. So what's going on is the first section right there, the not due, we're still waiting for them to pay for it, and it's still within the reasonable collection period that we gave them when we made the sale. So it's not yet due, and we're talking about that 30,000 right there is the amount of credit sales, like what's sitting in the accounts receivable because of those sales. That's not yet due. And then we have the 1 to 30 days past due category, where they should be paying it, they haven't paid it yet, and it's either somewhere between 1 or 30 days past the due date with its associated accounts receivable balance, and then each group has their own time frame with their own accounts receivable. So all we do is we're coming up with a percent that we think is going to be uncollectible from each group. When I say I come up with it, I don't mean us working out the problem. I mean, as a company, what you do is go, okay, it seems like as of a certain point in time, as time goes by more and more, it's more and more likely we're probably not going to collect that account, right? Because most people are going to pay their receivables as soon as they're due. You know, as a matter of fact, it looks like we think maybe 2% of the people where it's not due end up not giving us our money, like they end up not paying off their accounts payable, our accounts receivable. And as time goes by and more time goes by and it's further and further past due, we're going to budget for the fact that it's more and more likely that we're not going to collect that, hence the ever-increasing percent uncollectible. So long story short, all you do for this problem is to take each accounts receivable from the respective groups based on the time frame, multiply it by the percent that's uncollectible from each of those groups, get those numbers, add them all up, and again, that gives you your ending allowance for doubtful accounts, just like the percent of receivables method. So once you do all that, you know, you add, just multiply them across, add them all down, and you'll see that's going to give you 1,805 as your ending allowance for doubtful accounts. So in order for me to find my bad debt expense, that's just the adjustment from your beginning, assuming there's no write-offs or anything, which there was not in this problem. We begin with a certain amount, we make our adjustment, and that yields an ending amount. So it's the same information from the problem before as far as the beginning allowance for doubtful accounts. So we began with the 500. We funnel in the 1,805, the ending allowance for doubtful accounts, and the adjustment between the two must be our bad debt expense, which when you solve for that, that's going to give you 1,305. So you can see that just depending on the method you use, it will completely affect what you come up with your ending allowance for doubtful accounts and your bad debt expense. So just be very particular to keep in mind which method yields what, whether or not it's going to be one method, you take a percent of receivables, it gives you your ending amount, or the aging method gives you your ending amount versus the percent of sales method giving you the actual adjustment. So just keep all that, kind of nice in position. This should give you a good framework. So thank you for watching, and I hope that helped.